Imagine opening your brokerage app in early 2026 and seeing one ETF in your portfolio quietly paying you more income than everything else combined. Not because it's famous, not because some millionaire guru talked about it, but simply because it's built for one thing, paying you now, not in 2043. And while most people keep asking, which S&P 500 ETF should I buy? You and I both know that sometimes you want something a little spicier. Something where, when the dividend hits, you don't shrug and say, "Oh, that's cute." If any of this sounds familiar, stick around because the ETF we're breaking down today could genuinely reshape how income investors think in 2026. And no, it's not JEPI, not QYLD, and definitely not some 1.4% yield grandma ETF. Now, let me ask you a question real quick. Have you ever received a dividend so small it actually annoyed you more than it made you happy? Like, why even bother sending me 32 cents? I can't even buy a quarter of a coffee bean with that. That's exactly why a lot of investors are shifting their attention from the traditional dividend aristocrats toward enhanced income ETFs. These funds are designed with one purpose: turning market movement into income, without the investor needing a PhD in options. And the best part? Some of these new ETFs are starting to get very interesting. Imagine an ETF offering a yield close to 18%, with a share price in the $39 to $40 range, launched recently enough that big influencers don't even know it exists yet. While other investors chase AI stocks and argue about Nvidia's valuation, income-focused investors are quietly hunting for ETFs that pay them every month without needing the market to behave. Here's something important. Most high-yield ETFs don't perform magic. They don't create income out of thin air. They simply convert potential upside into real-time yield. Think of it like trading a bit of future dessert for a bigger dinner today. And if you're someone who likes the idea of your portfolio feeding you now instead of teasing you for decades, then this ETF is going to make a lot of sense. The ETF has already gathered around $30 million in assets, carries an expense ratio of 1.14%, and launched in late 2025, but still isn't being talked about by the big channels. That's usually a sign that retail investors haven't caught on yet, which means you're early. And being early in the income world is a very good thing. Alright, the ETF we're talking about is SLTY. This high-yield fund launched on August 2025, trading around $39, offering an annualized yield of roughly 18%, and using an enhanced income overlay to squeeze out higher distributions. This isn't your boring slow dividend ETF. This is the kind of ETF income-focused investors perk up at when they see the payout history. Understanding SLTY's strategy teaches you more about the future of income ETFs than any top 5 ETFs for beginners video ever will. SLTY uses a structure designed to take advantage of volatility to generate bigger payouts, meaning you don't have to manage complicated option positions yourself. Think of it as an automated income machine. You tell it, "I want yield," and it says, "Say no more." And while the yield isn't guaranteed and distributions can vary, the intention of the ETF is clear: prioritize income, then worry about everything else. Now imagine it's 2026. Markets are moving sideways, growth stocks are sleepy, and everyone is bored out of their minds waiting for the next rate cut. Meanwhile, SLTY holders are seeing activity each month. Is the NAV bouncing around? Sure. But for income investors, the NAV isn't the main meal. The cash flow is. And honestly, that consistency feels good. You open your broker account, see the distribution hit, and think, okay, at least something in this portfolio is alive. Let's be clear but brief. Yes, high-yield ETFs come with trade-offs. Yields can fluctuate, some distributions include return of capital, and during strong bull markets, these strategies may not outperform growth funds. That's the whole risk section, and now we're done with it. Back to the fun part. So, SLTY is interesting because it fills a gap that traditional dividend ETFs simply don't. People want income, not 1.8%, not 2.4%, but income that feels meaningful, income that hits your account and actually moves the needle. SLTY's strategy aims to deliver that, making it a compelling option for investors who want to build a portfolio that pays them regularly without having to constantly monitor stock charts. The very fact that SLTY is new means early adopters get to understand it before it becomes mainstream. Once bigger channels start covering it, once institutions begin noticing the cash flow structure, and once investors start comparing its payouts to traditional funds, that's when the attention grows. And attention is everything in the ETF world. One more thing that makes SLTY stand out is how it's built for the exact kind of investor who's tired of tiny dividends. Maybe you're building a passive income plan. Maybe you want your portfolio to help cover your rent or groceries or weekend pizza budget. Whatever the reason, funds like SLTY bring something fresh to the table. Not hype, not dreams, just cash flow. If you enjoyed this breakdown and you want more enjoyable, friendly ETF deep dives, consider subscribing to MoneyQuest Broker. It really helps the channel grow and lets me keep making content that actually teaches you something instead of repeating what everyone else already says. And one last thing. This video is for educational and informational purposes only. It's not financial advice or a recommendation to buy or sell any asset. Always do your own research or speak with a licensed financial professional. SLTY's yield, distributions, and performance can change over time. Never invest in anything just because someone talked about it online. Invest because you understand it.